Okay, folks, let's go ahead and pick this up. So tonight's class deals with the crooks and our emotions. So the first half is really about crooks. So some of you are thinking, now, Finley, why are you dressed up? Because you don't get dressed up. Well, because I want you to know what the crooks look like in the financial industry. They look like this, okay? They don't look like the hoodlum down somewhere with a hoodie on and they look like they're up to something. No, the crooks in this industry look upstanding. They look like, like they could be somebody you would trust. That's on purpose, of course. I've spent now the last 5 weeks intermittently talking about the industry and how they legally fleece you. But that's legal, right? That is perfectly legal on the deception in which much of the industry works. Tonight, we're talking about the true crooks, people who actually are out to steal money from you illegally. And as you watch the videos, because I do think the videos are going to tell this story better than I could, pause and notice the emotions that they tap into. Notice the fear, notice the greed, notice the overconfidence that they try to reach in you as they build that trust. And before you think, oh, I couldn't fall for that, be careful, right? People like Steven Spielberg fell for that, Kevin Bacon, and many other well-educated people have fallen under the deceptive and illegal practices of people who are there to fleece them. And I mean do it illegally. So let's get started. It's not going to let me escape there. So first, we're starting with the Ponzi scheme. What exactly is a Ponzi scheme? I think it's very important to understand how this works and how you can avoid one.
So, you may have heard about Ponzi schemes in the news. Everybody knows they're illegal, but you might not understand how they work. So Ben is here to show us. To start off, Ben gets a few people to invest their money with him. At the end of the year, he gives those clients amazing returns that beats every other investor in the market. Needless to say, the investors are thrilled. In fact, they're so ecstatic about all the money they're making that they tell all their friends and family about it too, who tell their friends, who tell their friends. In the stock market, most investors make money some years and lose money others. But Ben's Ponzi scheme? Yeah, it never loses money. In fact, it always beats the market by a huge margin. But the returns he pays to these people aren't from actual profits. He just takes the money these new guys invest and gives it to these guys. But as soon as you can't get enough new money from this group to pay these people, then the whole pyramid starts to crumble because they're not getting paid anymore. Ben and these guys who invested first made a killing, but these folks lost all their money. So the next time a guy like Ben tries to get you to invest in something that sounds too good to be true, it probably is. Just ask Ben.
Now, a real-life Ponzi scheme. The reason to understand people like Bernie Madoff is to know how crooks work, so in the future, you have a better idea of the history of how this plays out.
They cut us off at our knees. It's all fabrication.
Mr. Madoff, do you have anything to say?
My wife and I are resilient, we're strong. I think we're going to make it.
Mr. Madoff, say something to your victims.
Shakespeare understood, probably better than anybody else, how complicated human beings are.
There was a status element to investing with Bernie Madoff. A lot of rich people gave him their money, and you could say to other people, oh, I have this guy, and he invests with Bernie Madoff, and if he's good enough for the Palm Beach poobahs, then that says something about me as well.
Bernard Madoff, charged with fraud and money laundering, stands at the heart of perhaps the largest financial scandal in history. I'm Dennis Berman of the Wall Street Journal. Government documents tell plenty about Mr. Madoff, but there's still so many unanswered questions. Where did the money go? Why did people trust Bernie Madoff? How did Mr. Madoff pull off his alleged scheme?
What Madoff did very quickly and very savvily for his own purposes was he covered up what he was doing. He concentrated power in his own hands. No one knew his strategy. He wouldn't tell anyone. He presented it as so brilliant that it could not possibly be shared lest your head explode with the genius of it all.
He had this sort of under-the-radar investment operation that if you were in the right circles, you knew plenty about. When this scandal broke, that's what surprised a lot of people, is a lot of people didn't know he had an investment operation and just sort of knew the brand, the Madoff brand, as this trading business.
Madoff's start came in the 1960s. He was trading penny stocks at the time. Over time, though, Madoff got further into the plumbing of Wall Street, helping people use electronic trading methods to move millions of shares around the stock markets. Sometime during the 1980s, Madoff got less interested in moving stocks around the market and more interested in managing money for wealthy individuals. It's this advisory business that's in the crosshairs of the government investigation.
He operated for about 15 years before he came onto the scene by making an investment in the Cincinnati Stock Exchange and becoming more of a player in electronic trading. Up until then, he had operated in the world of over-the-counter stocks. If you look at his early clients, they were people that he knew from his neighborhood in Queens and Long Island. They were people that knew either his parents or his wife Ruth's parents. He found a lot of people who were very successful and wealthy, but not necessarily financially sophisticated. He worked in the trading business for 40 years, and it's notable that a lot of his clients on the investing side did not come from that business.
I think there's been a lot of misunderstanding about why people gave their money to Madoff, and the word I keep hearing is greed. People invested with Madoff because they were greedy, and there's no doubt some people did. But I think it was mostly about trust. People who were already on the inside with Madoff were very well respected in their communities, at the country club, at the business societies in their towns. And somebody looking for a money manager would turn to that person and say, who should I go to? And that person would say, oh, Madoff is the best, but you can only get in by invitation, and I don't know if he'll take you, but I could ask. And then people are just hooked.
The wealthy over the past few years ran into all of these investments that they didn't understand. In fact, for many of the wealthy, the less they could understand it, the better it was.
Above all, it was mystique. What was it about Bernie Madoff that made people hand over their life savings? What made Bernie so convincing? People were asking the same questions back in the 1920s when a sweet talker named Charles Ponzi had a plan that no one could refuse. Buy his international reply coupons abroad, convert them in the United States for cold hard cash. The scheme fell in on itself and Ponzi landed in jail for 5 years. But every generation, it seems, has its Charles Ponzi.
All you need to sustain a Ponzi scheme is for more money to come in than to go out. And as long as the incoming money is greater than the outgoing money, you can sustain it forever.
There's two types of Ponzi schemes. There's one that from the start is a fraud where the operator says, I'm going to take this money, and as long as I keep getting more money, I can keep this alive. The other is it starts out legitimate, something goes wrong, you make a bad bet on the market, and you can't tell your clients that you did this because you know if you do it, they'll probably lose confidence in your business is over.
I think what probably happened is a wave of redemptions hit Madoff, and he panicked, and he said, I can't do it anymore. Then he fessed up, then the whole thing fell apart.
My team and I tried our best to get the SEC to investigate and shut down the Madoff Ponzi scheme with repeated, incredible warnings to the SEC that started in May 2000 when the Madoff Ponzi scheme was only a $3 to $7 billion fraud. We knew then that we had provided enough red flags and mathematical proofs to the SEC for them where they should have been able to shut him down right then and there.
There have been warning signs for the better part of a decade. In 2000, a Boston-based money manager named Harry Markopoulos raised his concerns to the Securities and Exchange Commission. SEC investigated, and Madoff continued. In 2001, Barron's wrote in a magazine article its concerns about Madoff's investment returns.
Markopoulos was a competitor to Madoff in a lot of ways, and I'm sure that one of the reactions to his complaints might have been, well, that's just sour grapes. In 2001, there were 2 articles written about Bernie Madoff's investment strategy, and he basically described in broad terms a strategy using stock options that, at least in some quarters, created a lot of doubt about what he was actually doing.
Information I had from the options guys I had talked to didn't square with the returns. That was one sign. Then when I talked to some investors, people who had either cashed out of the fund or who had remained and thought Madoff was, you know, terrific, but even they couldn't explain what he was doing, that was the second sign. And then when I couldn't get him on the phone, that was the third sign.
The SEC continues to roar like a mouse and fight like a flea. But what I find the most disturbing about the Madoff case is that no one from the SEC has stepped forward to admit personal responsibility.
The Achilles heel of the SEC or the NASD is that those regulatory bodies have the same revolving door that the Food and Drug Administration has, the Environmental Protection Agency. It's essentially, if you work there, you know that 3, 5, 10 years down the road, you're going to end up getting a job in the industry you are now regulating.
Kevin Bacon, his wife Kira Sedgwick, Steven Spielberg all trusted their money with Bernie Madoff. Hedge funds, banks, even Madoff's own lawyers came to rely on what was quietly known as the Jewish bond. Money flowed in from around the world, from unassuming places like charities and nonprofits. One victim that's trying to make do is the Queen's Council on the Arts, which just lost a $10,000 a year fellowship.
We are the first stop for an artist who needs support, money, community, feedback, anything to support an artist and an artist's dream. We had absolutely no idea that there was anything awry. It was really the day before the news broke, I got a phone call from a mutual friend. The funds that you have allotted for the fellowship may be in danger, and that was all I knew. And then the next day, the news broke. I don't think I have the words to say anything to a man who perpetrated something as unbelievable as that.
If you would like to watch Chapter 2, it's on YouTube. The simple lesson there is when a crook offers you a guaranteed return of 10%, you know he's a crook because that's impossible and it can't be done. Problem is crooks come in other flavors. Sometimes they run companies. This is another example why it's unwise to invest in one individual stock.
It had taken Enron 16 years to go from about 10 billion of assets to 65 billion of assets, and it took them 24 days to go bankrupt.
Just an immediate sense of outrage at Lay and Skilling and Fastow when people realized how much they had profited and how completely artificial the appearance of this company had been.
That nobody could really understand, and in fact that many of Ken Lay's lieutenants questioned. They said this business can't be making this much money legitimately. Something weird is going on.
Mark-to-market accounting allowed Enron to book potential future profits on the very day a deal was signed. No matter how little cash actually came in the door, to the outside world, Enron's profits could be whatever Enron said they were.
Things that fascinated me was that almost all of the Wall Street analysts who covered Enron had buy ratings or strong buy ratings on the company's stock.
One analyst who didn't buy the company line became an enemy of Enron. Enron's CFO, Andy Fastow, had his eye on John Olson, one of the only analysts skeptical of the Enron story.
Enron loved analyst strong buy recommendations.
Merrill was informed by Fastow, either you get somebody who is on board with us and has a strong buy recommendation and loves us at the same time, or we don't do any business with you.
Merrill Lynch fired John Olson. Soon after, Fastow rewarded the bank with 2 investment banking jobs worth $50 million. His job was to cover up the fact that Enron was becoming a financial fantasy land. To please the boss, Fastow had to figure out a way to keep the stock price up by hiding the fact that Enron was $30 billion in debt. Enron was just stashing its debt in Fastow's companies where investors couldn't see it. LJM was Fastow's most ambitious creation. It would work magic for Enron, and it would allow Fastow to conjure $45 million for himself. Returns that would exceed 2,000%. 96 individual bankers invested in LJM, and America's major banks put up as much as $25 million each.
The Enron fraud is the story of synergistic corruption. There are supposed to be checks and balances in the system. The lawyers are supposed to say no. The accountants are supposed to say no. The bankers are supposed to say no, but no one who was supposed to say no said no. They all took their share of the money from the fraud and put it in their pockets.
Enron paid its advisors well. In 2001, the accounting firm Arthur Andersen received $1 million a week. Enron's law firm, Vinson & Elkins, did nearly as well.
Oh, for instance, one email I remember where the banker writes, Enron loves these deals. They produce cash, but they don't have to show the debt on the balance sheet. Now, a high school student can figure out that the banks were all knowing participants in this wrongdoing.
Merrill Lynch assisted Enron in cooking its books by pretending to purchase an existing Enron asset when it was really engaged in a loan.
California was selected by Enron as the prime place to experiment with this new concept of deregulated electricity.
Commodity that normally trades in the $35 to $45 range, high prices are when it gets in the 50s or $1,000.
Prices aren't going to stay at $1,000 forever. It weeds out the weak people in the market. Get rid of them, and you know what? The people who are strong will stick around it.
Traders soon discovered that by shutting down power plants, they could create artificial shortages that would push prices.
Guys to get a little creative, and come up with a reason to go down.
Like a forced outage type thing.
Right.
West Coast traders made nearly $2 billion for Enron.
The difference is between the state of California and the Titanic. At least when the Titanic went down, the lights were on.
In 2001, less than 4 months after Skilling's resignation, Enron declared bankruptcy. His accounting firm, Arthur Andersen, had begun destroying its Enron files. Enron's accounting firm, Arthur Andersen, was convicted of obstructing justice. With its reputation for honesty destroyed, America's oldest accounting firm fell along with Enron, and 29,000 people lost their jobs.
Next example is something that's close to home. Right? You think to yourself, well, this stuff happens in New York City and all these places. It couldn't happen here.
In this episode of American Greed.
If you're not trading with the best resources, it's time to get smarter.
He's a trailblazer with a fanatic ambition. And by all appearances, Russell Wasendorf leads one of the most successful trading firms of its kind.
Everything that I heard was fabulous. It was just something that everybody wanted to be a part of.
But if there's one thing Wasendorf knows how to sell, it's a brilliant lie. While more than $200 million goes missing.
He pulled off an audacious fraud for 20 years.
I concealed my crime so easily, but what wasn't simple was living with the guilt.
He's a thief. It's just who he is.
You can watch American Greed shows on CNBC. Some of those shows you might find on YouTube. It gives you insight into how crooks do their business. So Wasendorf, of course, was a futures trader in Chicago. He took his crooked business here. We'll talk about that a little bit later on. He ended up, of course, almost killing himself and ending up in prison for life, as did Madoff. Next guy is a real-life example through a movie, Wolf of Wall Street. Notice the ways in which he's able to create an environment for an investor.
Hey, I'm looking for an investor center.
Is that you want to invest?
No, investor center. I'm looking for investor center.
Yeah, that's us. Hey, oh, this is it. This is it.
Oh,
I'm Dwayne.
you're Dwayne.
Yeah.
Hi, Dwayne. We spoke on the phone. I'm Jordan Belfort. I'm the broker from Rothschild from New York.
Yes, yeah. Have a seat. How are you?
Remember, we had a
We
conversation
spoke on the phone earlier, right?
2 hours ago. Right.
אני לא מבקש לך לקנות את הסטאק.
Of course you never heard of them. They're up and comers. That's what that means.
3 cents a share. That's $3, you cheap fuck.
So, where are your Quotrons here?
Quotrons?
Yeah, computers.
No, we don't even need computers here. We just trade right off the pink sheets here.
Pink sheets?
Yeah, they're penny stocks. You know, companies that can't get listed on NASDAQ, they don't have enough capital, their shares trade here.
Penny stocks?
Yeah, this one, Aerotyne, is a really interesting, Aerotyne.
Aerotyne, yeah.
Aerotyne.
Aerotyne, yeah.
Very hot stock right now.
Yeah?
Yeah, they're just a couple of brothers that are making radar detectors out of their garage. They're out of Dubuque. Maybe it's microwaves. I'm not sure, but you call the company's main line. Their mom, Dorothy, answers, and she is so sweet.
The company?
I actually don't know what else to... I don't know anything else about them other than that.
6 cents a share? Come on. Who buys this crap?
Well, I mean, honestly, mostly schmucks. Postmen, there's always postmen.
Right.
Plumbers, they see our ads in the back of Hustler and Popular Mechanics, and our ads actually say they can get rich quick.
Hustler?
Yeah. You know the girly magazine?
Yeah. Nudie mag.
A lot.
Yeah.
We're helping them finance houses. We're helping them buy their wife a diamond ring, a boat, maybe.
Is this stuff regulated, or are you guys, what are you doing here?
Sort of.
Sort of? Jesus Christ, the spread on these is huge.
Yeah, and that's the point. What's your name again?
Mine, Jordan Belfort.
Jordan, what do you get on a blue chip stock?
I make 1%. I did make 1%.
Pink sheets, it's 50.
It's 50%? 50% commission?
Yep.
For what?
It's our markup for our services.
So if I sell a stock at $10,000, my commission is $5,000.
If you sell $10,000 worth of this stock, I will personally give you a blowjob for free. And I hope it happens.
Hello, John. How you doing today? You mailed in my company a postcard a few weeks back requesting information on penny stocks that had huge upside potential with very little downside risk. Does that ring a bell? Okay, great. Well, reason for the call today, John, is something just came across my desk, John. It is perhaps the best thing I've seen in the last 6 months. If you have 60 seconds, I'd like to share the idea with you. You got a minute? Name of the company, Aerotine International. It is a cutting-edge, high-tech firm out of the Midwest awaiting imminent patent approval on a next generation of radar detectors that have both huge military and civilian applications. Now, right now, John, the stock trades over the counter at 10 cents a share. And by the way, John, our analysts indicate it could go a heck of a lot higher than that. Your profit on a mere $6,000 investment would be upwards of $60,000.
Jesus, that's my mortgage, man.
Exactly, you could pay off your mortgage.
This stock will pay off my house.
John, one thing I can promise you, even in this market, is that I never ask my clients to judge me on my winners. I ask them to judge me on my losers because I have so few. And in the case of Aerotine, based on every technical factor out there, John, we are looking at a grand slam home run.
Okay, let's do it. I'll do $4,000.
4,000, that'd be 40,000 shares, John. Let me lock in that trade right now and get back to you with my secretary with an exact confirmation. Sound good, John?
Sounds good.
Great. Hey, John, thank you for your vote of confidence, and welcome to the Investors Center.
Yeah, thanks a lot, man.
Bye-bye.
How'd you fucking do that?
Just like that, I made $2,000. The other guys looked at me like I just discovered fire.
Catch You When You Can. It's a show. Yes, he was in that. Okay, so again, different versions of different crooks. And again, you watch them, you think, okay, bunch of suckers falling for pitches. I'm too smart for that. What I would ask you to remember is nobody's too smart. Every one of us is capable of falling under somebody's spell because they're really good at it. And by the way, it's not just us. You know, what about some of your relatives, especially older relatives? You have a grandmother who is, living in her home and she's stuck in her home and she's 90 years old, and somebody like him calls her up and shows her a lot of attention. Think how easy it is for her to fall under his spell. So part of this presentation isn't just to help you really understand how this works from a crook's perspective, but is to understand it so you can help your loved ones. Because every single day in America, people are getting ripped off by crooks. Saying that, right? Most people out there, they're not crooks. These are far and few between, but they exist. And so we have to be cognizant of that and be ready, because they're just around the corner. We just don't always know who it is and where they're at, but they're there. So they look like you and me, right? At a glance, they're human beings. They're nothing incredibly special, but they can certainly look the part, right? They can look impressive, whether that's through how they dress or what they drive or the office in which they work. And of course, they can also have pretty initials after their name. They can look very successful. Again, from appearances, you think, man, he knows what he's doing. That's how people fell under Madoff. They had to beg him to take their money. Think about that for a minute. Please, screw me. That's what was happening. They also sound successful, right? It's this idea that they are smooth talking, just like you just saw with that broker. They know how to talk. They know the buttons to push to get people to give up their money. And they do appear very smart, and in many cases, they can have credentials after their name. Those credentials, hopefully in their mind, builds confidence in you on their abilities. What I would ask you to be is as skeptical as possible. Not cynical. Cynical meaning everybody out there's a crook. Not the case. Again, most people are not. But skeptical enough to say, okay, you're telling me something that sounds too good to be true. So I'm going to withhold judgment on that, and I'm not going to buy it until I verify it with many other resources. People that I trust, because I don't necessarily trust you. So they do it through fear, right? Fear is a big part of it, right? Fear of loss. So Madoff pulled this off. You're missing out. You know, we're getting 10, 12% returns every year no matter what. So every day that you're not with Madoff, you're losing money, right? So it's the fear of loss in many cases where these people pull you in. And by the way, Ponzi schemes, they can last for years, many, many years. So here's an example. You have a friend who has been in a Ponzi scheme for years. They don't know it because they've been getting paid. All that new money was coming in, and they're now old money, and they're getting paid every year with their returns. Maybe they're receiving dividends. Maybe it's just the statement that shows how much they've made. Of course, the statement is just fake. It's not real. None of that money's invested. But they've been doing that for, let's say, 6 years. 6 years. And that's very easy to happen as long as new money's coming in. So your friend tells you this, and your friend actually does care about you. I mean, they're not trying to hurt you. And it's easy for you to think, well, I mean, it's been going well for 6 years. It must be, you know, on the up and up. No, not necessarily. A Ponzi scheme can last for a decade. So we have to be careful, even when something has lasted a while. If it's a Ponzi scheme, it's a Ponzi scheme, and at some point it will collapse. That's a guarantee. It's not a possibility, it's a guarantee. It's just a matter of when that new money starts to dry up. And a lot of times it dries up when recessions hit, when all of a sudden the economy starts to take a dip. So they feed off of greed and overconfidence too, right? The idea that I'm going to make a lot of money. And again, that tends to grab more men than women. Us men we can certainly fall for that a little bit. We can also fall for the overconfidence where somebody gives us the feeling like, man, you're smart, you know what to do, give me your money, you know how to make money. And so it's easy to fall under that umbrella of confidence that is going to hurt you in the long run. Because they do make you feel special. That's part of the whole allure. You're special, and so therefore you're going to get these great returns. But only special people do that. And if you're part of our little group, well, you're going to get them too. And of course, they use your lack of knowledge. There's an old saying, when a man with experience meets a man with money, the man with the money gets the experience, the man with the experience gets the money. It's true. And this is an example of that. So part of this presentation is about gathering that knowledge, gathering enough experience where you understand the history of markets and the history of the crooks that tried to figure ways around those markets so you don't fall for that. Because you can do everything right, folks. You can do everything right for years and decades. And you fall for one of these crooks, it could be all wiped out in a matter of days. So, you know, it's a serious game. And we shouldn't downplay it. It's an important piece of becoming a great investor is by understanding how these crooks work. And their approach, of course, they use that Ponzi scheme. That is a norm. Most of them use some version of a Ponzi scheme. Either they start out honest. So Wassendorf started out honest. He was doing nothing crooked. And what happened was he made a bad bet, and he lost a lot of money, and he didn't want to admit it because he thought he'd lose a lot of people. And so he cooked the books. He used new money to cover the losses. And in his mind, he was going to make it back. He was going to make a really good bet down the road and pay all those people back. Well, it never happened. So a lot of Ponzi schemes fall under that. Yeah, some start out a crook right from the beginning. Either way, they end up hurting a whole lot of people. Because they do make up numbers. And so those people in the Madoff situation, I don't think they quite understood this. So, you know, let's say you've been in with Madoff for 10 years and you've given him $800,000. And your statement says that you have $2.5 million with Madoff. You don't have $2.5 million. All you had was the $800,000 you put in. That's it. You never made any money with Madoff because that money was never invested. That was somebody else's money that was used to make you think that you were up to $2.5 million. So when those people were trying to get their money back after this scandal hit and the government was trying to pay them back, so to speak, a lot of them, in this case, wanted their $2.5 million. Dude, you never had $2.5 million. All you had was $800,000 that you had put in. And I got bad news. You're probably not going to get that. You might get, 8 cents on the dollar. Maybe you get, instead of 800,000, maybe we're going to get you 60, 70, 80,000 back. And of course, people are, they're stunned by this. It ruined lives. And you might think, that crook rate Madoff and the Enron boys and they are crooks, okay? There is no doubt about that. But none of them stuck their hand in your pocket, not one of them. People voluntarily gave them their money. So it's a reminder, this is on us. We allow crooks to happen. And we can stop crooks as an individual, not as a whole. They will continue to take advantage of people who don't know any better. But for us, by knowing better, we can stop them from hurting us and the people we care about. Because once they make you feel left out, it's very easy to want to be back in. And of course, they use your friends and family. It's an easy ploy, right? Again, somebody who's been doing well and they're a family member or a friend, they tell you about it and you feel like, okay, my friend would not, well, your friend's not trying to hurt you. They just don't know they're in his Ponzi scheme. But they will soon enough. So solutions, there's no free lunch, none, right? There's no 10% guaranteed return. Somebody says that, they're either a crook or they're delusional. Doesn't exist. It's too good to be true. Probably is, right? Knowing your history, knowing these crooks, and knowing the investment history that follows them. Because it's about putting up the shield, right? The shield that protects you. And that shield is called knowledge. It provides the knowledge that stops you from losing everything you got. I've been doing this a long time. I have a lot of people who say to me things like, well, what happens if I lose it all? And they're talking about the stock market. The truth is, this is how you lose it all. You don't lose it all with the stock market. Stock markets go up, they go down, they go up, they go down. This is how you lose it all. By falling under, the hand of a crook. Some final thoughts. They'll be around as long as humans are around, because we have emotions and they will use those emotions against us. Your knowledge will help you. Stay vigilant, right? Look out for yourself, look out for your loved ones, and then keep an eye out. If you see somebody who's promising something that you know is not true, bring it to somebody's attention. And, that guy who brought it to the government's attention, good for him. They didn't listen, of course, when it came to Enron. And people didn't listen when it came to Madoff for a long time. Sometimes people think the government's going to come in and make things good. Well, that's not going to happen. The government's going to come in after somebody like this happens, and they're going to get you, again, pennies on the dollar. They're going to try to help you, but most of the damage has been done, and it's not going to be corrected. The only way to avoid this is us, the decisions we make, so we don't let that happen. We don't learn the hard way. We learn from people who've learned the hard way. Any questions on this issue and crooks? It's pretty straightforward, right? I mean, honestly, you think, okay, Finley, yeah, I got it. Don't gonna do that. There'll be another story, another Madoff coming down the road. Just stay vigilant. Try to remember these men and how they do business. Next up, we'll hit on emotions. We'll start with our mind and what it can do to us.
How much would you pay for a bouquet of tulips? A few dollars? $100? How about $1 million? Probably not. Well, how much would you pay for this house? Or partial ownership of a website that sells pet supplies? At different points in time, tulips, real estate, and stock in pets.com have all sold for much more than they were worth. In each instance, the price rose and rose and then abruptly plummeted. Economists call this a bubble. So what exactly is going on with a bubble? Well, let's start with the tulips to get a better idea. The 17th century saw the Netherlands enter the Dutch Golden Age. By the 1630s, Amsterdam was an important port and commercial center. Dutch ships imported spices from Asia in huge quantities to earn profits in Europe. So Amsterdam was brimming with wealthy, skilled merchants and traders who displayed their prosperity by living in mansions surrounded by flower gardens. And there was one flower in particularly high demand, the tulip. The tulip was brought to Europe on trading vessels that sailed from the east. Because of this, it was considered an exotic flower that was also difficult to grow since it could take years for a single tulip to bloom. During the 1630s, an outbreak of tulip-breaking virus made select flowers even more beautiful by lining petals with multicolor, flame-like streaks. A tulip like this was scarcer than a normal tulip, and as a result, prices for these flowers started to rise, and with them, the tulip's popularity. It wasn't long before the tulip became a nationwide sensation, and tulip mania was born. A mania occurs when there is an upward movement of price combined with a willingness to pay large sums of money for something valued much lower in intrinsic value. A recent example of this is the dot-com mania of the 1990s. Stocks in new, exciting websites were like the tulips of the 17th century. Everybody wanted some. The more people who wanted the tulip, the higher the price could go. At one point, a single tulip bulb sold for more than 10 times the annual salary of a skilled craftsman. In the stock market, the price of stock is based on the supply and demand of investors. Stock prices tend to rise when it seems like a company will earn more in the future. Investors might then buy more of the stock, raising the prices even further due to an increased demand. This can result in a feedback loop where investors get caught up in the hype and ultimately drive prices far above intrinsic value, creating a bubble. All that is needed for a mania to end and for a bubble to burst is the collective realization that the price of the stock, or a tulip, far exceeds its worth. That's what happened with both manias. Suddenly, the demand ended. Prices were pushed to staggering lows, and pop! The bubbles burst, and the market crashed. Today, scholars work long and hard trying to predict what causes a bubble and how to avoid them. Tulip mania is an effective illustration of the underlying principles at work in a bubble. and can help us understand more recent examples, like the real estate bubble of the late 2000s. The economy will continue to go through phases of booms and busts. So while we wait for the next mania to start and the next bubble to burst, treat yourself to a bouquet of tulips and enjoy the fact that you didn't have to pay an arm and a leg for them.
Okay, well, let's see what real life looks like in 2008.
We're in the money. We're in the money. We've got a lot of what it takes to get along. We're in the money.
Apple's up more than 6% right now. Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Did not disappoint. 400 points higher. Yes, indeed. The market's roar higher last 30 minutes of trading as volatility once again rules the day.
Most of the techs this morning, if not all of them, have just exploded to the upside. We are better than 5% to the upside at NASDAQ, 114 points.
Our market reporters are standing by. Bob Pisani, have you ever seen anything like Nobel?
Yeah, that's a little strange here. We're down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year no yields went from 190 to 166 in the blink of an eye.
I have never live looked at the Dow Jones Industrial Board and seen a 600-point loss.
Who knows where this is going to end up? I mean, this is volatility we haven't seen, of course, since way before you and I were born, even before our grandparents, 1929.
So almost everything there completely wiped out. And the NASDAQ, everything and more has been completely wiped out.
The Dow traders are standing there watching in amazement. I don't blame them. The credit market
676 points down.
It was the worst day on Wall Street since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted. We're not getting the stop trading, and we see where the buyers are. We're just, every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Can't look at it after you buy it. It's so horrible.
We haven't seen anything like this probably since the Great Depression, I think it's fair to say.
We've had an 8-day losing streak in the Dow that in percentage terms puts it on par, close to the loss suffered in that crash in 1987, close to that percentage loss those 2 days in 1929.
Look at the move in Aussie yen just this week. This was 1 week, Maria. This market took 5 years to go higher. It's now down 40%.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This market is as volatile as you'll ever see.
Traders saying this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices so fast, so furious.
Cicero was right. We're in the last days of this country surviving. And how in the world can we find the billions of dollars that we're borrowing from China and Japan?
Well, we are just seconds to go until the start of trading at the New York Stock Exchange, and stocks are set to kick off
lower, a whole lot lower.
eBay is down 6.5%, and really you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
This could be the most serious recession in decades. And that means life, as most Americans know it, is about to change, in some cases dramatically.
Buddy, can you spare a dime?
Okay, that wasn't depressing at all, was it? Okay, so emotions are a huge part of who we are as human beings. There's no doubt about that. You cannot get rid of your emotions, but you can learn to harness them, learn to understand them when they start to bubble up. So, for example, when somebody is watching newscasts like that, how do you not react in a negative way? So the advice, of course, is don't watch newscasts like that. Whether markets are zooming up or zooming down, do not watch television networks feeding those emotions. That is detrimental to your wealth creating abilities over time. So it can cause stress, but that stress is created by us. Again, if you can stop and just acknowledge that, say, okay, I'm getting all worked up because of my emotions. I'm human. How can I find ways to deal with that? Well, one simple way is turn the television off and go for a walk. That's one way, right? Get away from the noise. Let your emotions try to simmer down. And again, I'm not just talking on the downside, I'm talking on the upside. Because people can get overly excited when markets are taking off as well. Thinking, oh my God, I'm going to make a fortune. Well, markets go up, markets go down, markets go sideways. They can ruin all the good you've done. So there's a plus and a minus. So you go through this class, you learn how to invest your money wisely. You put your money at a place like Vanguard or Fidelity, and you can sign on and see exactly what's doing. It's all there, no problem. And that's good. But there's a problem with that. You also have the ability, with one click of a button, to make a total mess in one moment in time because of some emotional reaction to whatever. So in today's world, that can be dangerous. You're in control, but sometimes that can be dangerous. Here's a story. So it was in 1987. I was investing my money. It was October of that year. You heard it talked about a little bit with that video. There was a time called Black Monday. Market went down about 23%. One day, 23%. And people were freaking out. I didn't know what the hell was going on. People would say, Finley, what are you going to do? Nothing. Well, I didn't know what the hell to do. I owned a mutual fund. I barely knew what the hell that was. I didn't know what I owned within that mutual fund at all. I was ignorant on the subject. And I did not have a computer because there were no computers. So it wasn't like I could go in and do anything. I basically ignored it because I didn't know what to do. Well, in that case, I was saved because I should have done nothing. But if I would have had a computer and I would have let emotions drive me, I could have sold on that day, which would have been detrimental to my wealth creation. That year in 1987, where the market went down 23% on one day, well, the market went up for the year. The market went up. So people don't always talk about those things. You have bad days, and you will have bad days in the market, and you will have good days. So the approach is very simple, and we know this from decades of research. It's the person who buys and holds. They hang in there through the good times and the bad. They don't let markets affect their emotional state to where they're trying to make some move, because that move, in almost all cases, is detrimental to your future. Just don't make moves that are going to hurt you. And it's easy if you're watching some idiotic news show or on the internet to make a move because those people are freaking out. Harnessing those emotions can end up making you a great deal of money over time. So behavioral finance, I have 4 books up here that can help. Those books can help you understand yourself, understand our brain, understand our emotions. So your biases can hurt you. Your biases, what you think you know. Well, what you think you know could be wrong. It happens to a lot of people. You think you know more than the market. No, you don't. We've talked about this. You and I don't know more than the market. What you think you know, of course, could be wrong. And you also have this mistake, some people make, of believing in a great man. This man is going to make a ton of money because he knows something. He's amazing. Happens all the time. People did it with Bernie Madoff. There is no guy or woman who knows the future of markets. They are not going to make every winning bet every step of the way. That person does not exist. Unless they're a crook. Then they may make every single bet right because they're cheating in one form or another. So the defense is pretty simple. Know thyself. Know those triggers. Know the things that causes you to react in an emotional way that could be detrimental to you in your future. Expose yourself to less media. That's a real simple solution. Just less media. Less internet, less television, just less. Less is more in this situation, I promise you. Know your history, right? Know the history of markets. So 2008, that was close to replication of 1929. So what does that mean? Well, it's likely, not definite, but it's likely it's a once-in-a-generation event. Meaning somebody experienced it in 29, and they never experienced that thing again. Somebody experienced 2008, and it's unlikely they will ever experience that again. Now, saying that, will markets go down in the future? Hell yes, they'll go down. I guarantee you they'll go down. It's just a matter of how much. Our job is to keep feeding those accounts. Because as markets go down, your money is buying more. Markets are on sale. So rather than seeing the negative, we change it to see the positive. And if necessary, get a good therapist, right? And I say it tongue in cheek, and yet there's some truth to it. A good therapist who can help you with your emotional roller coaster so you can become that robot that I talk about, where emotions are taken out of the decision making. Again, those resources, Your Mind in Your Brain by Jason Zweig. He was in that video with Madoff. And these other books do a great job of, again, helping us understand who we are and why we do what the hell we do. Because sometimes we do some crazy shit. Okay, why is that? The more you get to understand yourself, the better you're going to be as an investor. Because you start to see those triggers, you start to see when you're reacting in an emotional way, and you say, whoa, slow down, get my head on straight, and again, maybe you just go for a walk. But you definitely turn off the TV, you definitely tune out the noise coming from all kinds of sources out there, electronic. They need to be harnessed. Right? You can't get rid of emotions. I'm not here to say you can get rid of them. You shouldn't get rid of them and make you human, but you can harness them. Bubbles follow humans. There will be another bubble in the future. You know, some of you have experienced the dot-com bubble. You're going to experience other bubbles. You've experienced a real estate bubble. There'll be something else. We don't know what it is. Somebody out there is kind of pulling strings and something's going to happen. Don't get caught up in the idea that somehow you can avoid bubbles. It's hard to avoid bubbles. What you don't want to do is get caught up in the herd. where the herd is jumping to get in the bubble as fast as possible. They're the ones who get killed. So for example, dot-com bubble in the 90s. What a lot of people did was they sold their diversified mutual funds that owned all kinds of stocks all over the world, not just tech stocks, and instead they bought nothing but tech stock mutual funds. Dot-com companies only in a mutual fund. And so what happened? They lost 97, 98% on their mutual fund. So when you hear people say, well, I lost it all. Well, what were you investing in, dipshit? Because you were not investing in the entire U.S. market, I promise you that. You didn't lose 97% if you did. But again, it's people who get caught up in thinking, I'm going to get rich. And that's where some of those people were going. And they were making big bucks in those dot-com mutual funds until it collapsed. Herd behavior, you'll get trampled. Separate yourself from the herd. And that means, keeping your head, not letting those emotions drive your behaviors. And you become that robot as best you can, even though you are a human being. Questions on emotions? How about I ask some questions? Go ahead.
On your 4 resources that you recommend, Jason Wig is a writer for
Yep.
the Wall Street Journal. Are any of the other ones psychologists or psychiatrists?
Yep. So Daniel Kahneman won the Nobel laureate, and this is all about behavioral finance. So this book is about the psychology of human beings, and money just happens to be a topic in it. Money Brain and behavioral investment counseling, financial advisors who focus on our emotions. What they would tell you, what Murray would tell you is, you fix your emotions, that's the biggest thing you got to overcome. It's bigger than everything. Now, I'm not going to quite go there. I think emotions are a huge part of us and what we have to do to control them and harness them. There's other things that are important to you as well as you try to become that wise investor. So how many people experienced the dot-com craze? Yeah. 2008? Probably many of us, right? So I would call you seasoned investors. What does that mean? That means you suffered through it, okay? So for those of you who you haven't been through those time periods. So basically, if you were investing after 2008, so March 2009 was the worst of 2008, it's been going up ever since generally, then you're not quite that seasoned investor. So what I mean by that is, until you fully suffer the effects of what I'm talking about, it's not quite the same. So Zweig, he does presentations. Now, I don't do this because I don't want to give somebody a heart attack, but he'll do presentations talking about these emotions, and then he'll go inside a bag, and he'll throw a snake at the audience. So, my God, and they freak out, right? Because it's this idea like, I can tell you that snakes are scary, and you're like, yeah, But if you see a snake right in front of you, oh shit, and you jump, it's a whole nother effect. It is totally different when you experience it. So know now how to deal with these moments when they come, because they will come. And what you want to be that person who's standing firm with what they're doing. And everybody might be freaking out around you, and you're like, it's going to be okay. Keep feeding that account. Just keep feeding what you have been doing. Don't lose your head. And don't hang around people who are losing their head, because they can cause you stress. And I'm sure some of you experienced that in the past. Focus on what you can do to control you. And that's going to be the biggest reward you're going to get out of understanding emotions and you.
Your emotions change the older you get. Even if you're in your 70s or 60s or whenever you retire, you may see your entire retirement nest egg disappearing in front of your face.
How would that happen?
Well, if you're pulling out 7% like the government requires you to do because of your age, then you don't have time to recover on the next uphill very much because you got to take out 5, 6, 7% every year.
Okay, but as you get older, for some of you, many of you, you're going to go less stocks and more bonds. Focus on high quality bonds as that portfolio goes up and down. So there's no perfect bullet that you can put in a weapon and say, that's going to do it. But what you can do is provide yourself the best opportunities to do this so your money does last longer than you. And is that challenging at times? Sure. But it's been done. I've watched people go through this process. I've gone through this process. You can succeed in a world full of people who in many cases don't want you to. And that leads me to my story. So the story, I think, is perfect for a night like this. So once upon a time, this big old lion was looking for a drink of water. And he ambles up to this big lake. And as he walks up and he's about ready to drink, whoa, he sees another lion staring at him from the lake. And as he backs up, he goes back and he sees that lion. He growls at that lion. And the lion growls at him. And that lion's a little bit shaken up. And so, of course, he's a big, bad lion. So he comes together with his biggest growl. And he comes at that lion with a growl that would scare anyone. Well, that lion growled right back at him just as loud. And at that lion attacked that lion in the water. Well, of course, there was no lion in the water. He was attacking himself. He had created his own enemy. And I would tell you, a lot of people create their own enemy inside here. You conquer this, and your life can move in a much better direction going forward. And I'll leave you with that. Thank you, folks.